You know what separates the traders who make it from the ones who blow up their accounts? It's not intelligence, it's not capital, it's not even luck, it's knowing when to pull the trigger. I lost millions, not once, but multiple times before I figured out something that changed everything. Most traders think the hard part is finding the right stock or currency pair. Wrong. The hard part is knowing the exact moment to enter. And here's what's funny, I watched thousands of traders over my career. Smart people, educated people. They'd pick the right direction, identify the perfect setup, and still lose money. Why? Because they entered too early or too late or on nothing but hope and a hunch. Today, I'm going to show you the exact three-step test I developed. A test that works whether you're trading stocks, futures, or Forex. This isn't theory. This is what I used to turn $500, 0 cents, into millions. And what cost me fortunes when I ignored it. Stick with me until the end because I'll show you how these 3 steps could have saved me from my biggest losses and how they led to my greatest wins. Let's get into it. Here's the brutal truth that nobody wants to hear. Most traders are gambling. They just don't know it. They see a stock moving, they feel that rush of adrenaline, they click buy. Then they sit there, watching their position bleed red, wondering what went wrong. I've been there, trust me on this one. Back in my bucket shop days, I thought I was smart because I could read the tape. I'd see price action I liked and jump in immediately. Sometimes it worked. Most times, I was either too early and got shaken out, or too late and bought at the top. You know what I realized after losing my first fortune? The market doesn't care about your entry. The market is going to do what it's going to do. But here's the thing. There are moments, specific moments, where the odds shift dramatically in your favor. Moments where the market shows its hand. Moments where the risk-reward becomes so lopsided that not taking the trade is the bigger mistake. The question is, how do you identify these moments? Most trading educators will tell you about support and resistance. They'll draw lines on charts. They'll talk about indicators and oscillators and all sorts of technical mumbo-jumbo. And you know what? Some of that stuff works sometimes, but I learned something more fundamental. Something that works across every market, every time frame, every century. The market moves in the direction of least resistance. And if you can identify 3 specific conditions before you enter a trade, you're not gambling anymore. You're speculating with the odds in your favor. Let me tell you about the time I ignored these steps and it cost me everything. It was 1906. I had made a killing in the market and I was feeling invincible. Which, if you've traded long enough, you know is exactly when the market humbles you. The world had changed, and have been given the great pleasure of getting exactly 1% of what it should have cost average. I had been watching cotton. The trend was clear as day. It was going up. Everything I read, everything I heard, pointed to higher prices. So I did what any smart trader would do. I bought big, and I bought early. Here's where it gets interesting, kind of like when you're so sure you're right that you double down on a losing hand. The price didn't immediately go my way. It started drifting lower. Just a pullback, I told myself. The trend is still intact, so I held, and watched my position move against me. You know what I should have done? I should have waited for my 3 steps. But I didn't have them yet. I was trading on conviction instead of confirmation. By the time I finally cut my losses, I had given back a huge chunk of my profits. But here's the silver lining. That loss taught me more than a dozen wins ever could. I realized I had the direction right. Cotton did eventually go higher, just like I'd predicted. But I didn't have the timing right. And in trading, being right about direction but wrong about timing is the same as being completely wrong. That's when I started developing my 3-step test. A framework that would keep me out of trades until the market was truly ready to move. Let me show you what I discovered. After that cotton disaster and several other expensive lessons, I broke down every successful trade I'd ever made. I studied my wins and my losses with the same intensity I studied the tape, and I found something remarkable. Every single winning trade, the ones where I entered and immediately moved into profit, had 3 things in common, and almost every losing trade was missing at least one of these elements. So I created a test, a simple 3-step checkpoint before I'd risk a single dollar. Here's the framework. Step 1, identify the line of least resistance. Step 2, wait for the pivotal point. Step 3, demand confirmation. Now I know what you're thinking. Jesse, this sounds simple. It is. But simple doesn't mean easy. The hard part isn't understanding these steps. The hard part is having the discipline to wait for all three before you pull the trigger. Most traders fail this test at step 3. They see steps 1 and 2 line up, and they can't help themselves. They jump in early, hoping to get the best price. And you know what happens? They get stopped out right before the real move begins. I'm going to walk you through each step in detail. I'll show you exactly what I look for, how I apply it across different markets, and most importantly, how to avoid the traps that catch 90% of traders. But first, let me share something that might surprise you. These 3 steps work whether you're trading stocks in the 1920s or crypto in 2024. Why? Because they're based on human psychology and market structure, not arbitrary indicators. The market is made up of people. And people, whether they're using telegraph machines or smartphones, behave the same way under fear and greed. Ready? Let's break down step 1. The line of least resistance is the direction the market wants to go. Not where you think it should go, not where the fundamentals say it should go, where it's actually going. Think of it like this. If market psychology were a river, the line of least resistance is the direction the current is flowing. You can try to swim upstream if you want, but you're going to exhaust yourself and probably drown. Or you can wait until the current is flowing in your favor, then jump in and let it carry you. Here's what I learned the hard way. The line of least resistance reveals itself through price action, not news, not earnings reports, not economic data. Price. When I was starting out, I'd read the financial papers every morning. I'd consume every piece of news about the companies I was watching. And you know what? That information made me a worse trader. Why? Because news tells you what happened. Price tells you what's happening. Let me give you a concrete example. During the panic of 1907, the fundamentals were screaming that stocks were cheap. Bargain hunters were buying hand over fist, convinced they were getting deals of a lifetime. But I looked at the tape, I watched the price action, and the line of least resistance was clear. It was down. Violently down. Every rally got sold, every bounce got smashed. The market was telling me loud and clear I want to go lower. So what did I do? I went short, aggressively short. While everyone else was trying to catch falling knives, I was making a fortune, letting gravity do the work. Now here's how you identify the line of least resistance in any market. First, look at the higher time frame trend. I don't care if you're a day trader or a swing trader, you need to know what the daily and weekly charts are doing. If you're buying on a 5-minute chart while the daily chart is in a confirmed downtrend, you're swimming upstream. This applies whether you're trading UR/USD in Forex, ES futures, or Tesla stock. The principle is the same. Second, observe how price reacts to tests. Does price snap back quickly when it dips? That's an uptrend. The line of least resistance is up. Does price struggle to hold rallies and quickly reverse lower? That's a downtrend. The line of least resistance is down. Watch the character of the moves, not just the direction. Third, pay attention to volume and momentum. In an uptrend, you should see volume expand on up moves and contract on pullbacks. In a downtrend, the opposite. In Forex, you won't have volume, but you can observe momentum. Do moves in the trend direction happen swiftly, while counter-trend moves are sluggish and labored? Here's a modern example for you. Think about Bitcoin in late 2021. Every dip was being bought. People were calling for $100, 0 cents K, $500, 0 cents K, $1 million, 0 cents. The fundamentals, if you can call crypto fundamentals, looked bullish. But then something changed. The dips stopped getting bought as aggressively. Rallies started getting sold. The line of least resistance shifted from up to down. Traders who waited for that shift, who recognized the change in character, were able to short or exit before the real carnage began. Those who fought the new line of least resistance, they rode positions down 70 to 80%. Now identifying the line of least resistance is just the first step. You're not taking a trade yet. Why not? Because even when you know the direction, you still need the right entry point. You need to wait for what I call the pivotal point. And that's where most traders, even the ones who get step 1 right, still lose money. The pivotal point is the specific price level where the market makes a decision. It's the moment of truth, the line in the sand, the point where either the trend continues with force or it breaks down entirely. Here's why this matters so much. You can have the line of least resistance in your favor, but if you enter at the wrong level, you're going to experience unnecessary drawdown, get shaken out on noise, or worse, enter right before a reversal. The pivotal point is where the real traders separate themselves from the gamblers. Let me tell you what a pivotal point is not. It's not just any support or resistance level you draw on a chart. It's not a moving average. It's not a Fibonacci retracement. Those tools can help you identify pivotal points, but they're not pivotal points themselves. A true pivotal point has specific characteristics. First, it's a level where the market has proven significance. This could be a prior high or low that marked an important reversal. It could be a consolidation range that price tested multiple times before breaking out. It could be a level where heavy volume traded hands. The key is that the market has demonstrated that this level matters. It's not arbitrary. Second, it represents a point of commitment. When price crosses a pivotal point, it forces traders to make decisions. Stop losses get triggered. New positions get initiated. The market has to take a stance. Third, it often coincides with psychological round numbers. I noticed this early in my career. The market respects round numbers. Whether it's $100, 0 cents on a stock, 1 to 1,000 on EUR/USD, or 4,000 on the S&P 500, these levels carry weight because traders fixate on them. The classic trader takes note that half of the numbers on a mission across are neither skill nor passion. Let me give you a real example from my trading career. I was watching wheat back in the 1920s. The line of least resistance was clearly up. Every dip was shallow, every rally was strong. I knew I wanted to be long, but I didn't just buy anywhere. I waited. There was a price level, let's call it $1.50, that wheat had tested 3 times over the previous month. Each time it touched that level, buyers stepped in aggressively. Each time it launched higher. That was my pivotal point. I placed my orders to buy if wheat pulled back to $1.50 one more time, and you know what? It did. The moment it touched that level, I was in. And within days, wheat was making new highs. Why did this work? Because I wasn't guessing. I wasn't hoping. I was entering at a level where the market had proven that buyers would defend. I was entering at a pivotal point. Now, here's how you find pivotal points in modern markets. Chart stocks look for prior swing highs and lows, look for breakout levels from consolidation patterns, look for price levels where the stock previously gapped up or down significantly. Let's say you're watching Apple, it's been in an uptrend, line of least resistance is up. But you don't just buy it anywhere. You wait for it to pull back to a prior high that it broke through. That old resistance becomes new support. That's your pivotal point. For futures, same concept, but you need to be even more precise because of leverage. If you're trading ES futures, S&P 500, you might look for the previous day's high or low. You might look for the opening range breakout level. You might look for key VWAP levels. The point is, you're looking for levels where the market has demonstrated significance, not random prices pulled from thin air. For Forex, currency pairs love to respect previous day highs and lows, weekly highs and lows, and those psychological round numbers I mentioned earlier. If MUR/USD is in an uptrend and pulls back to 1,000, that's a pivotal point. Why? Because it's a round number, and price has likely reacted to it before. Here's the critical part that most traders miss. You don't enter at the pivotal point. You enter when price confirms the pivotal point is holding, and that brings us to step 3. The step that makes all the difference between consistent profits and frustrating losses. But before we get there, let me ask you something. Have you ever entered a trade at what looked like the perfect level, only to watch it immediately go against you? Have you ever been stopped out right before the move you predicted finally happened? If so, drop a comment below. I want to hear your story. Because what I'm about to share next would have saved you from that pain. This is where the magic happens. This is what separates professionals from amateurs. You've identified the line of least resistance. You found your pivotal point, and now you wait. You wait for the market to prove to you that it's ready to move. I know. This is the hardest part. Because by the time you get confirmation, you feel like you're late. You feel like you're missing out on the best entry. But let me tell you something I learned after going broke multiple times. It's better to enter late and be right than to enter early and be wrong. In my entire career, I made far more money entering trades after they started working than I ever made trying to pick exact bottoms or tops. You know why? Because when you wait for confirmation, you're trading with the market instead of against it. You're letting the market show you that your analysis is correct before you commit capital. Here's what confirmation looks like. First, price action confirmation. This is the most important type. You want to see price react to your pivotal point in a way that demonstrates strength. For a long trade, you want to see price touch your pivotal point, or come close, hold, and then make a strong move higher. Not a weak bounce. A decisive move that shows buyers are in control. For a short trade, you want to see price hit your pivotal point, fail to break through, and then make a strong move lower. What does strong mean? It means the candle closes decisively in your favor. It means the next candle continues the move. It means there's follow-through. Second, time confirmation. Sometimes the best confirmation is price action at a specific time. In my day, I'd watch for how the market behaved at the opening and the close. Those were the moments when the real money made their moves. Today, you might watch for the London Open in Forex, or the first hour of trading in stocks, or the overnight session close in futures. If price holds your pivotal point during these key times, that's powerful confirmation. Third, volume and momentum confirmation where applicable. In stocks and futures, you want to see volume expand as price moves in your favor from the pivotal point. That tells you that real capital is getting involved. In Forex, you can look at momentum. Does the move accelerate away from your pivotal point? That's confirmation. Let me tell you about one of my most famous trades. Shorting into the 1929 crash. The line of least resistance had been up for years. But by late 1929, I started seeing cracks. The character of the market was changing. Then, in late October, we hit a pivotal point, a level where the market had to decide. Was this just a correction, or something bigger? But here's the thing. I didn't short immediately when we hit that level. I waited. I waited for confirmation, and it came in the form of vicious selling pressure, break of support, and complete absence of buying interest. That confirmation, that proof that the market was ready to fall, is what gave me the conviction to press my short positions aggressively. Without that confirmation, I might have shorted too early and gotten squeezed on a relief rally. With it, I rode one of the biggest moves in market history. Now here's how you apply this in modern markets. Stock. Example. You're watching Nvidia or whatever tech stock is hot right now. The line of least resistance is up. It's in a clear uptrend. It pulls back to a pivotal point, let's say a prior breakout level at $400, 0 cents. You don't buy at $400, 0 cents. You wait. You want to see price touch $400, 0 cents, hold, and then break above the previous day's high with volume. That's your confirmation. That's when you pull the trigger. For example, you're trading USD/JPY. The line of least resistance is up. Dollar is strengthening. It pulls back to a pivotal point at 149. Nice round number. Previously supported multiple times. You don't buy at 149. You wait. You want to see price touch 149, hold, and then break above the high of the pullback candle with momentum. That's your confirmation. Futures, example, you're trading crude oil. The line of least resistance is down. Supply concerns are easing. It rallies to a pivotal point at $80, 0 cents. Previous support turned resistance. You don't short at $80, 0 cents. You wait. You want to see price hit $80, 0 cents, fail to break through, and then break below the low of the rejection candle with expanding momentum. That's your confirmation. Do you see the pattern? You're not guessing, you're not hoping. You're letting the market prove to you that your analysis is correct. And here's the beautiful part. When you get confirmation, your stop loss is obvious. It goes just beyond the pivotal point. If you're going long and price breaks back below the pivotal point, you were wrong. Cut it. Move on. If you're going short and price breaks back above the pivotal point, you were wrong. Cut it, move on. This is how you keep losses small and let winners run. This is how you stack the odds in your favor. But here's the final piece of the puzzle. Let me summarize this entire framework so you can use it starting today. Before every trade, ask yourself these 3 questions. First, what is the line of least resistance? Look at the higher time frame. Watch how price reacts to tests. Is it easier for price to go up or down? Second, where is the pivotal point? Find the level where the market has proven significance. Where will the market make a decision? Third, do I have confirmation? Wait for price action, time, or volume and momentum to prove your analysis is correct before entering. If you can answer all 3 questions with confidence, you have a trade. If even one answer is unclear, you wait, you watch. You preserve capital. This discipline, this patience, is what allowed me to turn small amounts into fortunes multiple times in my career. And it's what will separate you from the 90% of traders who blow up their accounts. Remember that cotton trade I told you about? The one where I lost because I entered without these steps? I eventually made that money back and more, because I learned to respect the market's timing, not just its direction. You can be right about everything and still lose if your timing is off. But when you use this 3-step test, you're not just right. You're right at the right time. And that's what makes all the difference. Now I want to hear from you. What's been your biggest challenge with entries? Are you jumping in too early? Too late? Without a plan? Drop a comment below and let me know. And if this video helped you, share it with another trader who needs to see this. Too many good people are losing money because nobody taught them when to pull the trigger. Subscribe if you want more trading wisdom from the greatest speculator who ever lived. And I'll see you in the next one.